I want to talk about timing investments and tied into that dollar cost averaging. One of the reasons that investors don't often get the returns that longer term stock market trends would predict, i.e. 10 to 15% for example, is because of human nature. We tend to get very, very excited when investments are doing well and potentially buy them. And we tend to get very disappointed or even depressed when investments aren't doing well and may end up throwing the towel. Now that's a part of human nature, and it's also magnified by the press. The real estate market is focused on when it's doing well and people get very excited. The real estate is not focused on when it's doing poorly. And the reality is when things are doing poorly, that's when smart investors want to be investing. And when things are doing well and everybody's expecting higher prices, sellers are pricing things highly, buyers are paying high prices because for the fear of missing something, that's probably not the best time to buy. Now that's human nature, and we can try and compensate for that, and we can become savvier investors as time goes by, and certainly that will make a difference in the returns that we get. And bearing in mind the aspects of human nature, that people do tend to get more excited when things are doing well, and being aware of these things and not going with the crowd and recognizing that the smartest time to invest might be when the crowd is not doing it. If it's a very sound investment, because prices won't reflect those high expectations. These are all things that we can work on and things that we can develop with time, and they are incredibly important skills to have. But when you take that in the context of a stock market that also varies from year to year, as we saw, in such a volatile manner, and in a manner where it's difficult to predict the short-term movements because of unanticipated events, but where we can be much more sure about the longer term trend, and as we can see historically, can be certain that over historic periods it's gone up over 10, 20-year periods, whereas in 1-year periods it's often declined. That means that there is an opportunity to automate a part of our investment process, recognizing that things move up and down in this pattern. And the methodology that we could use to do that is known as dollar cost averaging. And very briefly, and I'll show an exhibit shortly, very briefly, if we put, for example, $20 into an investment that costs $20 in the first month and the investment costs $10 in the second month, then the average price of that investment over the 2 months was $15. It was $10 in the first month and $20 in the second month. Now, if we put in $20 into that investment for those 2 months, months 1 and 2, and then the first month when it was $10, we would have bought 2 units, and the second month when it was $20, we would have bought 1 unit. So we would have invested in total in those 2 months $20 and $20, which is $40, and we would have ended up with 3 units, the 2 that we bought in the first month and the 1 that we bought in the second month, and we would have ended up paying an average price of $40 divided by 3, which is $13.33. So in other words, even though the investment average price was 10 and 20, which is 15, we ended up paying 13.33 because we bought more units when the price was low, i.e. 2, and less units when the price was high, i.e. 1. And you can do that on the back. It's a simple mathematical thing that works on the back of an envelope. But the reason it works is because we're putting in the same amount of money, and when prices are low, we're buying more units. If we had bought obviously 1 unit at 10 and 1 unit at 20, then the average price would be 15. But we didn't do that. We bought 2 at 10 and 1 at 20. And so the price is pulled down towards the 10. And that's the principle of dollar cost averaging. What it basically means putting in the same dollar amount every month, and as the asset moves up and down in price in a volatile fashion, i.e. as would be the case with a stock or in the stock market, we're buying more units when the price is low and less units when the price is high. And we can see how that might be done if we put, for example, over a 12-month period, $100 into a stock every month, and as the stock price goes up and down, we can see in the following chart how many units we bought every month. We end up paying an average price in this example of $19.01. If we take the average price, we add up all the price of that stock over the 12 months and we divide by 12, we end up with 19.33. So the bottom line is, in a volatile investment where it's somewhat difficult to predict the short-term movements, and also in the interest of saving time and having something running in the background while we're focusing on other things, i.e. our ability to make money, which is also very, very important in our personal lives, we can have an automated dollar cost averaging system running, which basically buys more units at lower prices and less units at higher prices, gets around some of the psychological aspects that human nature would pull us to, i.e. getting more excited about investments when they're rising and less excited when they're falling, as human nature would tend to make us do. And we can benefit from buying more units at low prices and less units at high prices, therefore lowering our average price, and we can automate and save time. So that's the principle of dollar cost averaging, and how it ties into timing of investments that are volatile, and where in the short term it may be difficult to predict where they're exactly going to go.